There are almost 2,000 properties scheduled to be auctioned this week. That's up 16% on the same week last year. New South Wales will hold about 800 auctions, with 639 of them in Sydney. Victoria will hold 700 auctions, with virtually all of them in Melbourne. Queensland will hold about 250 auctions, with 159 in Brisbane. South Australia will hold 115 auctions, with most of them in Adelaide. Western Australia, Tasmania and the NT will hold 17 auctions between them, and the ACT will hold 62 auctions. Take a look at the most viewed properties going to auction this weekend. In New South Wales, top property is 31 George Evans Road, Killarney Vale on the Central Coast. This large four-bedder could do with a renovation. Top property in Victoria is 4 Allambie Avenue, Capel Sound, which is on the Mornington Peninsula. This four-bedder has 3 bathrooms. The top property in Queensland is 20 Swansea Street, Annerley, just south of the Brisbane CBD. This spacious four-bedder has a pool in the backyard. Top property in South Australia is 66 Martin Court, West Lakes, near Port Adelaide. This giant newly built home comes fully furnished. And the top property in Canberra is 5 Amadeus Place, Colleen. This four-bedder sits on about 820 square metres. And the most viewed property on the REA Group website this week is a large stately home located at 114 East Terrace, Adelaide. This home overlooks the lovely parkland which surrounds the Adelaide CBD, and it's being billed as potentially the last residential development opportunity on the East Terrace. The ad says this circa 1936 home was once owned by News Corp founder Rupert Murdoch. This four-bedder has 2 bathrooms and space to park 4 vehicles and large, well-maintained and designed garden. The asking price is $5 million and the agents are currently taking expressions of interest. Well, REA Group, which is majority owned by News Corp, reported its half-year profit results yesterday. I caught up with Chief Executive Owen Wilson at their Sydney office, and we started by talking about the results, followed by some pretty hot topics like changes to negative gearing and the undersupply of housing. Owen Wilson, thanks so much for your time. Let's just start. Interest rates in Australia right now appear to be at their peak. How did the first half track for REA Group in regards to the property market and just listings overall?
Look, the first half was very positive. We finished the half 4% up nationally in listings, and it was a tale of 2 stories though within that 4%. Melbourne and Sydney were incredibly strong, running at very strong numbers up on the half, offset by weaker conditions in Brisbane, Perth and Adelaide. They're actually down in the half. As we move into this half with that great interest rate outlook, we expect those other geographies to start to recover as well.
Yeah, have you been surprised at all by just how strongly the market seems to have bounced back in late January, early February this year?
Not really. Once interest rates started to stabilise and consumers got a bit of confidence that we weren't going to see another 2, 3, 4 rate rises, you could see the buyers back in the market. And as those buyers came back, a couple of things happened. House prices started to go back up, and we got a new record in November. And the sellers started coming back to the market because of that demand. Days on site, so the number of days it took to sell a property, were running at low levels on a 6-year average.
Yeah, and what about website traffic? Like, how much interest is there right now?
A lot. We saw buyer inquiries up 15% in the half, which shows that level of demand. And as I said, houses are coming off the site quite quickly. So you can be confident now that if you list your property, you are going to sell it, provided you're reasonable with price. And in that market, we're seeing a lot of activity.
When you take a few steps back and look overall at Australia, is there a serious problem, though, with an undersupply of housing?
It is the number one issue in Australia at the moment, is undersupply of housing. And you see that at its worst in the rental market. If you look at rental vacancies, they've been falling for some time. You've only got to see every week on the news, there's a story of 70, 100 people turning up to an open for inspection for a rental. So it's diabolical. We are getting a benefit in our business, believe it or not, in our flatmates business. People are starting to reform share accommodation, and that business is up 28% in the half as people realised they couldn't get rental properties and had to start sharing again. But overall, we've got to start constructing more housing, both apartments and house and land. We're starting to see the bottom of that market, but there's a lot more to go.
And you look at the front pages of the newspapers right now suggesting the government may try and change negative gearing laws. Do you think that's going to have an impact on the investor space in the market?
I think that would be a huge negative impact on the investor space. Already in the past 2 years, we've seen a lot of investors leaving the market, partially due to the interest rate increases, but partially also due to some pretty draconian tenancy laws in some states. It's been driving investors out of the market. That's the last thing we need when there's a rental shortage. If you make it unattractive for investors to make properties available for renters, there'll be nowhere for renters to live.
Yeah, so if changes do occur with negative gearing, what might the market look like in a couple of years?
Well, you'll end up in a situation where people can't find accommodation. They can't afford to buy and they can't afford to rent, or they can't get rental properties. And I think the government, if they cause that to be worse than it is today, I don't think that'll be a good thing.
Okay, looking at some of your other businesses, India market clearly still in growth phase. Interest rates in India are about 6.5%, but how is the Indian business tracking?
It's going incredibly well. It grew revenue 21% for the half, but within our core business, our flagship site, housing.com, it grew 32%. We're now the clear number one in terms of audience in that market at about 1.4 times our nearest competitor, and it's growing well. It's a great property market. Interest rates are higher at 6 and 7%, but historically for India, that's actually quite good. So we've got both a good market and we've got a big move towards digital from traditional marketing.
Now looking at the overall company as well, operating costs up about 11%. What are some of the big cost drivers during that half year?
We're a people business, and so obviously wage growth was in there. We put our wages up from July like most companies do, but we're also starting to invest in new product, things like AI. We've got some great developments, which I can't talk about, coming into our products in the coming years, and it's been investing in new tech talent to help build that.
Yeah, I know you made some small early stage equity investments. It is small, $10 million odd, but are you always on the lookout for new ventures?
We are. Anything to do with property, we think can help us improve our experiences for our consumers or our customers. This year, for example, in July, we took ownership of Campaign Agent. It's a business that helps fund marketing schedules so consumers can defer that payment. It was a great bolt-on acquisition. It's been performing incredibly well. Revenue up 90% in the half. And so those types of things we're always looking out for.
Yeah, and in the outlook statement it talks about you're expecting costs to go to the mid to high teens. So just explain, is that an increase in investment, or is that more wages, more staff, more marketing costs?
No, it's an increase in investment. We typically try to run our business so that revenue growth is above our cost growth. And we said in the first half of the first quarter results that as we got the line of sight on revenue, we might increase our investment. As we've seen the revenue come through in a really strong market and a great revenue performance, we've decided to tweak up our investment, particularly in new products and experiences for our consumers.
Looking at the US, you've got a 20% equity stake in Move Inc, which has the Realtor platform. That didn't have as good a half year, but what's the difference between the US and the Australian market?
There's a couple of fundamental differences. One is here we monetise listings, so people pay to advertise on our site. In the US, it's a lead-based business, so you sell leads to agents. The other fundamental difference are the two markets. We've had a really good property market in Australia. They've had the worst property market since the GFC in the US. Their 30-year fixed-rate mortgage went up to nearly 8%, which is like nearly a 30-year high. And so transaction volumes are now down at GFC levels. The good news is that interest rate has started to come back down, and we should see those transaction volumes start to recover, but very contrasting markets. Healthy market in Australia and probably one of the worst markets they've seen in the US for decades.
Another market you're in is Vietnam. Just give us an update there.
That's been very subdued. The government, it got quite hot a couple of years ago, and so the government took action to cool the market, and they put in some very hefty laws around how much you could borrow for apartments and houses and things like that. And it worked. It cooled the market. They've since lifted those measures and the market hasn't recovered yet. So consumers are still sitting on their hands, and so transaction volumes are quite low in that market.
Overall, though, looking ahead to the rest of this half year, how confident are you about the future?
Oh, we're very positive about this half. As we come into February, listings have stayed at very strong levels, both nationally and still in Melbourne and Sydney. The markets are very, very strong. Our customers are telling us that the outlook for vendors that they're talking to is very good, so people are looking to bring properties to market. And as I said, in a market where none of us are really expecting much rate movement at all in terms of interest rates, I think we're going to have very strong demand with continued immigration, low unemployment, coupled with vendors who are very confident of selling their properties. So we feel very good about the market.
Yeah, Commonwealth Bank economists are expecting 3 rate cuts later this year and 3 next year. So I guess that increases people's borrowing capacity and should really put more interest back into property?
If that happens, it'll be a very strong market because people will be able to borrow more. It will definitely underpin house prices. I don't share that view. I think we might see one rate cut this year, but I hope the Commonwealth Bank economist is right.
Owen Wilson, Chief Executive at REA Group. Thanks so much for your time.
No, thank you.